You know what? Nobody wants to hear about turning $100,000 into a million. It is simple. A child could do the mathematics. 10% annually for 24 years equals just over $1 million. But here is what breaks my heart after watching this for 75 years. 99% of the people who actually manage to save $100,000, which is more money than most Americans will ever accumulate, will never see that million. Not because the math stopped working. The math always works. They'll fail because they can't sit still. Let me tell you something about myself that might surprise you. I succeeded because I have a long attention span. That is it. That is the secret everyone's looking for. Not intelligence, though that helps. Not connections, though those matter. Not even luck, though I've had my share. Just the ability to sit in a chair and wait. Most people can't do that. It is contrary to human nature to just sit there all day doing nothing, waiting for an ordinary person. Can you imagine sitting for 5 years doing nothing? You don't feel active, you don't feel useful. So you do something stupid. I'm 99 years old now. I've watched thousands of people accumulate capital and then destroy it. Same pattern every single time. They scrape together $100,000 through years of discipline and sacrifice. Real money more than most people will ever save. They're excited. They think they've made it. Then within 5 years, that capital is gone. Completely gone. Not because the stock market crashed. Not because the economy collapsed, because they couldn't leave it alone. They quit their job to pursue their passion, which means turning their hobby into a failing business. They buy a boat they'll use twice before it sits in storage, costing them thousands annually. They invest in their brother-in-law's restaurant, which has a 90% chance of failure like all restaurants. They panic during a market correction and sell at the bottom, locking in permanent losses. Or worst of all, they just get bored and start trading. They mistake activity for progress. 5 years later, they're back to zero, wondering what happened. I'll tell you what happened. They never understood the game. The game is absurdly simple. Take your 100,000, invest it in a low-cost index fund. Don't touch it. Don't trade it. Don't get clever. Just leave it alone at 10% annually. 7 years gives you 200,000. 14 years gives you 400,000. 24 years gives you just over $1 million. Same money, same rate, just time. That is the entire formula. But here is what absolutely destroys people. Those first 7 years feel like torture. Pure psychological torture. You watch your 100,000 turn into 110, then 121, then 133. The increments are insulting. You're adding 10 or 12,000 a year while your buddy who bought Bitcoin is up 300%. He is bragging at dinner parties. Everyone's impressed. You're sitting there like a chump watching your boring index fund crawl along at 10% while he is getting rich quick. So you get tempted. Maybe I should try something exciting. Maybe I should leverage up. Maybe I should day trade. Maybe I should buy that hot stock everyone's talking about. And that is exactly when you destroy yourself, because you're confusing activity with progress. You're letting your emotional need for excitement overrule your rational understanding of mathematics. Let me tell you about a mistake I made back in the early 1960s. Now pay attention to this, because buried in this story is a lesson that cost me dearly and might save you from making the same error. I had finally accumulated some capital. Not a fortune, but enough to matter. I understood compounding. I'd read Benjamin Graham. I knew the principles cold. But I was young. I was ambitious. I wanted to prove I was smart. So when an opportunity came along that looked brilliant, complex financial engineering with smart people involved, promising impressive returns, I jumped. I thought I was being clever. I was being stupid. I violated my own circle of competence. I invested in something I didn't fully understand because I wanted to accelerate the process. The investment didn't blow up completely, but it hurt. I lost time and capital. More importantly, I learned what would become one of my core principles that I've repeated so many times. Warren probably has it memorized. Don't try to get rich fast. Try to get rich for sure. The desire to get rich fast is pretty dangerous. It kills more wealth than market crashes ever did. The people who successfully compound 100,000 into $1 million aren't geniuses. They're not lucky. They're not particularly sophisticated. They just have the emotional discipline to do nothing for 2 decades. That is it. That is the entire secret. But doing nothing is the hardest thing in the world. Your brain won't cooperate. Human psychology is wired for action. We evolved on the African savanna where sitting still got you eaten by predators. You had to be alert, reactive, constantly moving. Those instincts kept you alive 10,000 years ago. They'll keep you poor today. Modern wealth requires the exact opposite of evolutionary instinct. It requires ignoring threats that aren't real. Market crashes, volatility, inflation scares, recessions. It requires patience when everything in you screams for action. It requires trusting mathematics over emotions. Most people can't do it. I've spent decades studying what I call the psychology of human misjudgment. 25 cognitive biases that make even intelligent people act like fools. When it comes to compounding 100,000 into a million, 3 biases kill more people than all the others combined. First is recency bias. Whatever happened yesterday, you assume will happen tomorrow. The market went up 20% last year, so you think it'll go up 20% this year. You buy at the top. Or the market crashed, so you think it'll keep crashing. You sell at the bottom, you're always fighting the last war. You can't see the longer cycle. The solution is to zoom out, look at 100 years of market history. Crashes happen, they always recover. Every single time, if you sell during the crash, you lock in losses. If you hold through it, you compound through it. But recency bias makes you think this time is different. It never is. Second is overconfidence bias. You hit 100,000 and you think you're Warren Buffett. You start believing you can pick stocks. You start thinking you understand markets. You don't. You got lucky or disciplined or both, but you're not a genius. I've met actual geniuses, Nobel Prize winners, people who can do mathematics I can't even comprehend. Half of them can't manage their own portfolios properly. Intelligence and investment temperament are not the same thing. The former is genetic. The latter is learned through painful experience. If you think you're smart enough to beat the market, you're about to get humbled. Just buy an index fund and shut up. Third, and this one's the absolute killer, deprival superreaction tendency. The moment you accumulate capital, you feel entitled to spend it. You've been sacrificing for years. You've been driving an old car, skipping vacations, living below your means. Now you've got 100,000 and your brain says I deserve a reward, so you buy a new truck. $40,000. Congratulations, you just cut your capital by 40%. You just extended your timeline to 1 million by a decade. Was the truck worth 10 years of your life? Most people never do that math. They just feel deprived. So they spend, then they wonder why they never build wealth. The answer is simple. You keep resetting the compounding clock. Every time you pull money out, you're starting over. Compounding only works if you let it work. It is like planting a tree and digging it up every year to check the roots. The tree never grows. Your capital never grows. Now let me walk you through what actually happens when you compound 100,000 into 1 million, because this is where theory meets brutal reality. Year 1, you invest 100,000 at 10%. End of year, you've got 110,000. You made $10,000. Sounds great until you realize you can't even take a decent vacation with 10,000. You feel like an idiot. Your neighbor just bought a Tesla. You're sitting on 110,000 watching paint dry. Year 2, you're at 121,000. You made 11,000 this year. Still insulting. You start questioning whether this is even worth it. Maybe you should pull it out and start a business. Maybe you should buy real estate. Maybe you should do something that feels productive. The correct answer is no. Do nothing. Keep compounding, but most people can't resist. They feel stupid. They need validation. So they blow it up. Year 5, if you've somehow resisted temptation, you're at 161,000. You've made 61,000 in 5 years. That is better, but it is still not life-changing money. You're not quitting your job. You're not buying a house. You're just slightly less broke than you were. This is where discipline matters. Can you keep going when the results are still disappointing? Most people can't. They've been saving and investing for 5 years and they've got almost nothing to show for it. So they quit, they cash out, they buy something stupid, and they guarantee they'll never reach 1 million. Year 10, if you're still in the game, still haven't touched it, you're at 259,000. Now we're talking. You've more than doubled your money. You're finally starting to see the power of compounding. But here's the trap that catches people right here. You start thinking you're smart. You start believing you can do better than 10%. You start taking risks, you start trading, you start leveraging, and you start losing. This is overconfidence bias at its finest. I've watched brilliant people destroy themselves right at this point. They compound successfully for a decade, then they get cocky. They think the rules don't apply to them. The market reminds them otherwise. The correct move at year 10 is the same as year 1. Do nothing. Just keep compounding. But the psychological pressure to do something is overwhelming. You feel like you've earned the right to get clever. You haven't. Stay humble, stay boring, stay patient. Year 15, you're at 418,000, more than quadruple your starting capital. This is when the magic starts becoming visible to your emotions, not just your spreadsheet. You're earning $40,000 a year from your capital. That is a salary. That is real money. This is also when people start making life changes. They quit jobs they hate, they start businesses, they take risks. Sometimes it works. Often it doesn't, because they're confusing capital with cash flow. Your 418,000 is not spending money. It is a compounding machine. If you pull it out to fund a lifestyle change, you've just killed the golden goose. The goose lays golden eggs. When you leave it alone, you eat the goose, you get one meal, then you starve. This is basic, but people don't think clearly when they smell freedom. Year 20, you're at 673,000. You can taste a million. You're so close you can almost feel it. But this is statistically the most dangerous time in the entire journey. People get impatient. They think they can accelerate the last stretch. They start taking bigger risks. They leverage up. They concentrate positions. They do all the things they successfully avoided for 20 years. And they blow up right before the finish line. I've seen this happen so many times it would make you sick. Someone compounds successfully for 2 decades. They're months away from $1 million. Then they do something stupid. They invest in a friend's startup that fails. They buy options that expire worthless. They panic during a correction and sell. They're back to 400,000, all because they couldn't maintain discipline for 24 final months. The lesson is simple. The last mile is the same as the first mile. Don't get clever. Don't get impatient. Just keep compounding. The mathematics don't care about your feelings. They care about your behavior. Year 24. You're at 1,058,000. You made it. Congratulations. You're now wealthier than 90% of Americans, not because you're brilliant, because you didn't do anything stupid for 24 years. That is the whole secret. Now here is what most people don't understand about this journey. It is not linear, it is exponential. But exponential growth looks linear for a very long time, then it looks vertical. In the first 7 years, you go from 100,000 to 200,000. That is $100,000. In the second 7 years, you go from 200,000 to 400,000. That is another 200,000. Same time period, double the absolute gains. In the third 7 years, you go from 400,000 to 800,000, $400,000 in 7 years. Same rate of return, but the absolute numbers are exploding. This is what people miss. They quit during the linear phase. They never see the exponential phase. They look at year 3 and think this isn't working. You just can't see it yet. The compounding is happening in the background, laying the foundation. But foundations are boring. They're invisible. They're underground. People want to see the building. They don't want to wait for the foundation to cure. So they start building prematurely and the whole thing collapses. If you want to compound 100,000 into $1 million, you need to make peace with boredom. You need to accept that most of this journey will feel like nothing's happening. You need to trust the mathematics even when your emotions are screaming at you to do something. I'll tell you what helped me. I stopped checking. Seriously, I'd make an investment and then I wouldn't look at it for years. Not because I was disciplined, because I was busy. I had a law practice. I had clients. I had a life. I didn't have time to obsess over my portfolio. And that accidental inattention saved me. I couldn't panic sell because I wasn't watching. I couldn't get greedy because I wasn't tracking every tick. I just let it compound. The people who destroy themselves are the ones who check their balance daily. They watch CNBC, they read every market headline. They feel every fluctuation emotionally. That is exhausting and it leads to bad decisions. You can't trade your way to $1 million. You can only compound your way there, and compounding requires inactivity. It is waiting that helps you as an investor, and a lot of people just can't stand to wait. Now let me tell you about the psychological warfare that happens during market crashes, because this is where most people lose the game permanently. You've been compounding for 10 years. You're at 250,000. Then the market drops 40%. Suddenly you're at 150,000. You just lost $100,000. Worse than that, you're back to where you were 6 years ago. 6 years of sacrifice, discipline, patience. Gone in 6 months. That is not theoretical. That is 2008. That is 2020. That is every major crash in history. And it will happen to you. Guaranteed. The question is not whether you'll face a crash. The question is whether you'll survive it. Most people don't. They see their balance cratering. They panic. They think this time it is different. They think the system is collapsing. They think they need to preserve what is left. So they sell, they lock in the losses. Then the market recovers, it always does. But they're not in it anymore. They're sitting on cash, too terrified to reinvest, watching from the sidelines while the market goes back up. They've just guaranteed they'll never reach 1 million because they sold low and they'll never have the courage to buy high again. I lived through the 1970s. Stagflation, malaise, oil shocks, recessions. The market went nowhere for a decade. Everyone said equities were dead. Buy gold, buy real estate, get out of stocks. The ones who listened stayed poor. The ones who ignored the noise and kept compounding got rich. Why? Because the businesses underlying those stocks kept operating. Coca-Cola kept selling soda. See's Candies kept selling chocolate. The Washington Post kept printing newspapers. The earnings kept compounding even though the stock prices were flat. If you owned the businesses and you held on, you did fine. If you traded the stocks and panicked, you got killed. The same pattern repeated in 2000 and 2008 and 2020. Crashes happen, they're brutal, they're terrifying. They feel like the end of the world, and they're the best buying opportunities you'll ever see if you have the temperament to recognize it. But most people don't. Their lizard brain takes over, the part of the brain designed to run from predators. That brain sees a market crash and says, danger, flee, sell everything. Your rational brain knows this is temporary. Your emotional brain doesn't care. It wants safety now. If you let the emotional brain win, you'll stay poor forever. This is why I say temperament matters more than intelligence. If you're not willing to react with equanimity to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder. And you deserve the mediocre result you're going to get compared to the people who do have the temperament, who can be more philosophical about these market fluctuations. Intelligent people panic just as badly as stupid people, maybe worse because they can construct elaborate narratives justifying their panic. I need to preserve capital. This time it is different. The system is broken, all sophisticated sounding nonsense. The real reason they're selling is fear. They can't admit it, so they rationalize. The ones who get rich are the ones who can override that fear. Not because they're brave, because they trust the mathematics more than they trust their emotions. Let me give you a specific example so you understand exactly what I mean. Suppose you started with $100,000 in January 2000, worst possible timing, right before the dot-com crash. By October 2002, you're down 30%. You've got 70,000. You just lost 3 years of progress. Do you panic and sell? If yes, you never recover. You lock in a 30% loss and you miss the entire recovery if you hold. If you just sit there doing nothing like a statue, by 2007, you're back to 140,000. Then 2008 hits. The financial crisis. By March 2009, you're down to 90,000. Now you're underwater, 9 years in, and you've lost money. This is where 99% of people quit. They can't take it anymore. They've endured 2 crashes in 9 years. They're done, they sell. Biggest mistake of their lives. Because if you just sat there by 2014, you're at 200,000. By 2019, you're at 350,000. By the end of 2024, you're at 700,000, same 100,000, same investment. You just had to survive the pain. You just had to sit still while the world was ending. The people who sold in 2002 or 2009, they're still broke. They missed the entire compounding. They let fear override mathematics. Now let me talk about opportunity cost of stupidity, because this is what people never calculate properly. Suppose you start with 100,000. You invest it. 5 years in, you're at 161,000. Then you see an opportunity. Your friend's starting a business. He needs capital. He promises huge returns. You pull out your 161,000 and invest it. The business fails. Most do. You lose everything. You didn't just lose 161,000. You lost the million it would have become in 19 more years. You traded a certain million for a possible 10 million, and you got zero. That is not investing. That is gambling. And gambling is just a tax on people who can't do math. Every dollar you pull out of compounding is a vote for future poverty. Every dollar you leave in is a vote for future wealth. Most people vote for poverty repeatedly and wonder why they never get rich. The answer is you kept interrupting the process. Compounding is like a long-distance flight. You can't get off in the middle and walk. You have to stay on the plane until it lands. If you bail out halfway, you don't get partial credit, you just die. Same with compounding. You can't compound for 10 years. Pull the money out, then start over and expect to reach $1 million on schedule. You just reset the clock. You'll need another 24 years from that point. Do that twice and you've turned a 24-year journey into 50 years. Most people don't have 50 years. They've got maybe 30 or 40 working years. If you keep resetting the clock, you'll run out of time before you run out of excuses. Let me tell you what happens when you finally hit $1 million, because this is important and nobody prepares you for it. You'll expect to feel different, rich, successful, validated. You won't. You'll feel exactly the same. The number in your account will be bigger. Your life will not feel dramatically different. This confuses people. They spent 24 years chasing $1 million, and when they get there, nothing changes emotionally. So they think they did something wrong. They didn't. They just misunderstood what wealth is. Wealth is not a feeling. It is a number. It is options. It is freedom. It is the ability to say no. It doesn't make you happy. It doesn't solve your problems. It just gives you a different set of problems. Better problems, but still problems. The real value of $1 million is not what you can buy with it. It is what you don't have to do anymore. You don't have to take a job you hate. You don't have to tolerate a boss who disrespects you. You don't have to stay in a city you dislike. You have options. And options are the closest thing to freedom that money can buy. But here is the catch that nobody tells you. By the time you reach $1 million through disciplined compounding, you've become the kind of person who doesn't need $1 million. You've learned discipline. You've learned patience. You've learned to delay gratification. You've learned to live below your means. Those skills are more valuable than the money itself because those skills will protect the money and they'll help you compound it further. The people who reach $1 million and blow it immediately are the ones who got there through luck, inheritance, lottery, sale of a business. They never develop the character required to keep wealth. So they spend it. Within a few years, they're broke again. The people who compound their way to $1 million almost never lose it because they've internalized the principles. They've become the kind of person who accumulates and preserves capital. That transformation is the real prize. The $1 million is just evidence of the transformation. Now here is the harsh truth that nobody wants to hear. Most of you listening to this will never reach $1 million. Not because you can't, because you won't. You'll start strong. You'll save for a year or two. Then life will happen. You'll need a new car. You'll want a vacation. You'll see an opportunity. You'll get bored and you'll quit. You'll tell yourself you'll start again later. You won't, or you will, but you'll quit again. This pattern will repeat until you're old and you've run out of time. Then you'll blame the system. You'll blame the economy. You'll blame your parents, your boss, your bad luck. You'll blame everyone except yourself. But the truth is you had the same opportunity as everyone else. You just lacked the discipline to see it through. That is not a moral judgment. It is an observation. 99% of people lack the temperament to compound wealth. They're too impulsive, too emotional, too short-term. They want results now. They can't tolerate delayed gratification. And in a modern economy, that guarantees poverty. If you're in the 1% who can sit still, who can delay gratification, who can trust mathematics over emotion, you'll be fine. You'll compound your 100,000 into $1 million, then into 3 million, then into 10. Not because you're special, because you're rare. And rare abilities command rare rewards. You constantly see people rise in life who are not the smartest, sometimes not even the most diligent, but they are learning machines. They go to bed every night a little wiser than they were when they got up. And boy, does that help, particularly when you have a long run ahead of you. So here is my final word. If you have $100,000, protect it like your life depends on it. because your financial life does depend on it. Don't spend it, don't loan it, don't gamble with it, don't get clever. Just invest it in a simple index fund and leave it alone for 24 years. Check on it once a year, rebalance if you must, but otherwise forget it exists. Go live your life, build your career, raise your family, let the mathematics work in the background. In 24 years, you'll have $1 million, maybe more if you contribute along the way, and you'll look back and realize the hardest part wasn't the investing. It was the not investing. It was resisting the urge to do something. Because in finance, as in life, doing nothing is often the smartest thing you can do. Sit on your ass investing, you're paying less to brokers, you're listening to less nonsense. And if it works, the tax system gives you an extra 1, 2, or 3 percentage points per annum. The world rewards action. Wealth rewards patience. If you want wisdom, you'll get it sitting on your ass. That is the way it comes. Choose wisely.